As I mentioned, I'm Ann Rossley. I'm here with my dear friend and colleague, Kyle Harvey, as well as our mortgage partner, carolanne.bozarth. Carolanne is here to help us get through all the ins and outs of what's going on in the mortgage market today.
So it's important to help our clients understand that again, I think we've even used this quote on the show, you date your rate, but you marry your home. So let's get that house that you need and want now. And if you can deal with this payment, which once I broke down, a quarter of a point in the interest rate was not significant enough for them to stop their search.
If, let's say you had a $400,000 mortgage you were going to get 6 weeks ago, 8 weeks ago at 6.5%, and today it's 7.5%. So you've got that 1% interest rate differential on $400,000. What does that do for a buyer in terms of monthly payment?
So that's $268 a month in the payment.
We're not saying that that's immaterial to some households, but if you do it for a while, you get the house that you want to be in, or the home that you want to be in. Yes, it might mean you got to cut back on some things, but it's still doable.
Years ago, when we had higher interest rates, people looked at adjustables, but they're not the answer today for most people, right? There's not as much of a differential between a 30-year fixed and, say, a 7-year ARM.
Yeah, unfortunately, I think a lot of real estate agents are assuming that, because that used to be the case. I've had a lot of my agent partners asking me, can they just do adjustable? Isn't that better? No, unfortunately, right now it's not. The 7-year ARM, the 10-year ARM, the pricing is just not there. It's like an eighth lower than a 30-year fixed. So that really doesn't make sense. Yes. So buy downs are back. Buy downs have actually, permanent buy downs never left us, but nobody was talking about them. So I am finding that this is a very interesting, unique way to kind of approach today's market.
Tell us what a buy down is.
Sure. So a buy down is just buying down the interest rate. Okay. So
by making a payment.
By a one, right. So it's the seller buying down the buyer's rate. So as a seller, why is this interesting and why is this beneficial for you to sell your house that's been listed and it's not moving? It's potentially going to help you, because if one of the problems that the listing is not selling is this interest rate market, right? So it's buyers that are like, they're just not coming in the door because they're reading headlines or they're uneducated. They don't realize, right? So having the seller offer to buy down the rate and putting that in the listing, what does that do? That's going to possibly get you a buyer in the door that you can actually negotiate what this buy down really means. So for the seller, so let's just use for simple numbers. How this works is the seller decides how much are they willing to part with. It's very similar. It's nothing more than a seller credit, but it's a seller credit that's being used to entice people and to help people come in the door. So let's say that the seller says, I'm willing to part with $10,000. So the buyer comes in the door and they have $10,000 to use to buy down the rate. So they very well may be able to, let's just use our old example. You've got on the $400,000 loan, you take that $10,000 and let's just say that will get you. Now, how much will the $10,000 get you depends on the day. It also depends on the profile of the buyer, what their credit score is and such. So, but we're just going to talk very general here. Let's just say that the $10,000 bought the rate down to 6.5%. That means that buyer's payment is now $268 less. If you had done a $10,000 price drop, instead of doing the buy down, the payment would have gone down $50.
Wow.
So it's an effective way to bring a buyer and a seller together And it really makes more sense on the seller side. They might have had to, in order to even get it to pop or get somebody in the door, drop it $20,000 in their purchase price. And then they're not even going to maybe get that purchase price, right? Because
Right.
No, this is much better.
You're right.
Much
It's
better.
much better.